Everyone calls themselves a startup. I'll tell you the truth. Your marketing agency is not a startup. You're building branding for a company, that's not a startup. Your software agency is not a startup. The word startup has a very specific meaning and purpose. Confusing startup with small businesses is the biggest financial mistake you can make. I spent the last decade building and scaling companies through investment rounds, through angels, through Y Combinator and Generator. And the number one question I get from every single founder is, should I raise money and where should I raise money from? Those are the wrong questions. The right question is, what am I actually building? Because the answer determines how you scale, how you hire, how you build product, how you go to your customer and your GTM also, go to market strategy also. So stop asking the wrong question and start answering what you actually are. So there is basically like 3 different categories, and then the 3 different categories is a business. This could be small business, this could be even bigger businesses, and then there is level 2, which is startups, and then there is enterprises, and 4th one is government contract. And the reason why I put this in this level is because a business can change into a startup can become an enterprise can often get government contracts, but even startups and businesses can also get government contracts, and that is why I arrange it in this mechanism. But a startup can never be a business, an enterprise can never be a startup. With this knowledge, let's see exactly what each one of these things are. Let's think about what is a business. So when you have a business, it's something called a cash flow. From day one, you have more employees, you have more stores, you have inventory capacity. You either need to put a small initial investment into your business, or you don't need an investment at all. But from day one, you have net positive cash flow. And then this revenue or this turnover is, exactly proportional to the number of employees, the number of stores, your inventory capacity, and your logistics. So this could be for both, service or product business. If you're a marketing agency with 10 people, your turnover could be $100,000. If your marketing agency is 100 people, then you might be well over $1 million. So your revenue is tied to the number of people, the number of stores, what your product is, all these things. Obviously, you will fine tune to make your profit margins higher, but the turnover still is linear. The very good examples are agencies, restaurants, social media, content creators, all these people who are selling a service or a product. Now, this can be scaled. A linear model is extremely scalable. So let's say you have one location with 10 staff. That exact model can be copied to the next location and then the third location. But your turnover is still linear, and instead of you making $20,000 per month, now you would make $40,000 per month. But that's still growing in a linear method even as you open multiple locations. So Subway has 37,000 locations. They just copied a linear model 37,000 times, even though it's a franchise. There is so many examples of this. Any dental clinic chain, multi-city agencies, they all have exponential, like they have massive turnovers, but the profit, if you see, is always less than 50%. So let's go to level 2. Keep this graph in mind because we will come back to this graph, but we'll go to startups. So startups are fundamentally required to operate on a net negative during the first, let's say 1 year, or let's say even 6 months. Today with AI, it's much easier to scale a startup. Whatever took 2 years to break even, 3 years to break even can be done in under a year. So it's very good time to be a startup. So you operate on a net negative initially, and this net negative is usually given to you by an angel or sometimes even a VC. But from start, you have to plan your exit plan. Exit plan meaning once you have a product, you have really good scalable solution, you need to start thinking about how do I sell my stocks and then exit with a big win. How do I get my company to be acquired by Google or Oracle or Microsoft, huge players? They can write you a $500 million check. They can give all the necessary inputs, infrastructure, people working on your product, your vision to take it to the next level. So you're fundamentally thinking about acquisition. Or the other plan that you need to make is if your startup is going to become an enterprise or not. So we'll get back to this point a bit later in this video. But with startup, once you break even, your growth curve is exponential. Your profits are also going to be much exponential down the line. The reason being, you are a small team, but your product or service can cater to multiple people. The users can grow despite having small team, right? You're not tied to having to service, or you don't need multiple humans, you don't need the logistics, all those things to grow in an exponential manner. So think of like Canva during the early stages, Zepto, Razorpay, Uber, Lime in the US, all these companies. So you're burning cash, and then you break even during this point. You should be thinking about getting like 1 million in ARR, annual recurrent revenue. And then the minute you touch 1 million in annual recurrent revenue, it's very easy to raise Series A, and then you think about raising Series B. And then let's go to enterprises. Enterprises are something that's already making well over $100 million, like $50 million to $100 million in terms of revenue. They have already IPO'd their company, which means the company is publicly traded. They have a C-suite decision makers, so CEOs, CTOs, CIOs, COOs, operating officer, chief information officer, and a lot of different C-suite decision makers. I would say something between 4 to 10. Very good example of enterprise is Starbucks, Walmart, even Canva, because when you think about this model, enterprise model, what Canva did is very clever. They were a design tool, then they became a presentation tool. Now you can also build websites and produce videos, and you can also print on demand with Canva right now. You can print your business cards, and it's not in all regions, but it's coming to multiple regions now. So what they are doing is they are doing end-to-end control of the supply chain, whether it be software or hardware. So in Canva, if you are able to design, you should be able to print, right? So they are thinking about the next step. Now, if I were to guess, Canva can also have a bunch of business designers in place. So you can order a business card to be designed, and then that gets printed also. So you are controlling the entire chain from left to right. So that's what's called horizontal expansion, or new verticals also. So this is what this curve looks like, and Salesforce, Walmart, all these are like really good examples of an enterprise. What I'm going to do now is I'm going to put them on a nice graph, and here you can see the linear model is actually going up in terms of the revenue until saturation, and then new locations opens up. Perfect business model. I think there is nothing wrong with this model. A majority of the world economy runs in this linear model, and that's completely okay. And then you have your enterprises, which tops out on a TAM, and then they either expand or they plateau. And then eventually, if they are in a plateau stage for too long, they also go down, and then the company needs to shut down. But enterprise usually have a very good sustainable model that can carry them for 10 to 20 years. You can see the startup curve, which is a J curve that burns cash exponentially, and then the revenue is basically tied to users, and then your annual recurrent revenue and per unit economics. Then you are actually like surpassing a business, and if you are a really good profitable startup, you also surpass enterprises. Okay, let's look at how you fund your startup. So there is obviously 4 ways. You can either bootstrap and keep all the equity for yourself, and then you have angels, then you have VCs, and then traction. So I'll tell you simple calculations. This doesn't work for all startups, but for a micro SaaS or a very small platform with a niche target, you are targeting like $10,000 or $50,000 in MRR. You do not need to raise any money. You can just build the product, you can just launch it, you can put your own money into the table, and then build it. And then you have angels. Angels are very picky. They only invest in 4-5 companies at max, but this usually works for SaaS platforms, smaller teams, subscription models. And capital required to win is $50,000 to $500,000 just to build, and then spend it on marketing, go and acquire your customers, and this works great. And then you have VCs, which is either a platform that connects multiple people, or this is something that requires very good scale. Lots of R&D, maybe the technology might not be copied by others, a good amount of technical people to win in this, in platforms or businesses that can scale. So that's why you need a lot of investment. You need like 1 million to 50 million plus rounds, and they usually tend to invest 100 to 200 companies on a yearly basis. And then you have something called traction. Basically, what you can do is you can sign enterprise contracts without needing any investment. And then you are building for the enterprise. So whatever problem that they face, you understand that, and then you are able to build products for them from day one, having LOIs, having pre-orders, having revenue, even before you have products. We'll get back to this model later in the video, but I will go to the next slide, which actually talks about 3 ways to fund your company. Again, as I mentioned, bootstrap, angels, venture. But here is the thing, with bootstrap, you own the entire company. Angels usually want around 20 to 30% of your equity. Venture capital wants around 15 to 25% of your equity, but there is a big change. You hustle, you put your life savings, you commit time in terms of bootstrapping model. You take the risk, and then this works for micro SaaS and niche tools. Angel investors, you are a founder, you have good product market fit, they evaluate only you, and then you have early demand signals, but you get diluted. Plus now you have board members who needs to have some kind of control over the company as well. This is best for SaaS. Now you might have the third part, which is like venture capital. They evaluate your TAM, SAM and SOM. This is extremely important. I'll get back to this in this video. But you have a team, and then you have early traction. You have path to $100 million plus in terms of revenue. You have heavy dilution, even though they take only, let's say, 10% initially. They would want you to raise Series A, Series B, and they would keep investing in your company as your company grows. So you would dilute around 40% to 50% of your company, and then you lose control of your company, and your CEOs, CTOs can be replaced because the board managers control the company. Again, this is extremely good if you have built a scalable product and you want to grow your businesses to $100 million plus, and you want to have an exit. You need to always think about, when you go into venture capital, you need to think about exit from day one. What are you going to take home end of the day? So what you need to do, validate faster, de-risk the bets, get better terms, and that's all you need to do. Wrong money kills companies as often as no money does. You can build your company slower with no money, but getting money from the wrong team who doesn't understand your product or your market, the company will kill the company faster. I'll tell you the VC math now. Why does VC want to invest in only companies that's going to make $50 million plus per year? VC math is very simple. They invest into 100 companies. They invest $1 million into 100 companies. This is just a rough example. $100 million investment fund is going into 100 companies. And then the math is brutal here. 60 companies fail. So 60 million is lost. And then 30 companies break even. And they break even maybe not as good as they expected. So 30 million to 90 million in terms of returns, and this happens over a span of 8 to 10 or even sometimes 15 years. So by that point, due to inflation and all the other reasons, even though you're getting like 1 to 3 times your returns, it's not much, but they expect 10 companies to win huge, to return 10 or 100 times what they invested, and that's why VC math is brutal. So here is the math. You can pause your screen and go through this. VCs want you to be a $500 million plus outcome, and that's not greedy, that's just math. That's how they can get the return on investment. Now you understand the models, financial models and funding sources and VC math. Let's go on to your business model. Your business model is very, very simple. You need to decide this by the first 3 months of your startup. You are either a B2B, you're a D2C, you're a B2B2C, or you are a B2B, you're a B2E. And then the failure rate is right here. So B2C companies often just fail. The CAC is brutal. CAC is basically cost associated to acquiring each customer. You're competing with a lot of attention, social apps, consumer tools, lifestyle products. All this work for very short time and then they fail. D2C, massive volume. One ad platform changes the entire distribution. Shopify stores, e-commerce brands, subscription boxes. All these are D2C. And then you have B2B2C, leveraging customer bases. It's lower CAC because you're basically you're connecting two different groups of people, like distributors and then whoever wants that product. A good example of B2B2C is Zomato, DoorDash, payment aggregators. All these are B2C. So you are leveraging existing customer bases. And then you have, which has this B2B2C has a good 50% success rate. And then you have B2B. B2B is, I think, the sweet spot for most of the startups because the contract values are much higher. You have lower churn. lower churn because you're having a business as your partner, and then it's difficult for them to change and train employees around a different product outside of yours. So if you sell a product or a service to a business, they will stick with you and walk the journey with you for 3 years, 5 years, 10 years. And they are like rational buyers. So they don't take they don't switch away from your platform. You have profitable and predictable revenue models, which is huge and which is like incredibly good for investors. A good examples of these are HubSpot, Salesforce, Slack, Freshworks, all these platforms. B2E is hardest to get in because you need the right connections. Once you start your B2E businesses, the scaling is insanely good. You are completely protected in terms of your revenue, and hospital, EHRs, enterprise analytics, defense contract, all this comes into B2E. And once you have the contract, you are like set for next 20 plus years. But again, you need the right connection, you need to pull the right strings, and you need to know people for B2E market. Here is a graph that shows why some models survive and why some don't. The economy behind failure models. Customer need. For a B2C, you need a lot of people. You're selling like $9.99 per month or $5 per month. You need 1 million users to make it profitable, like to make it scalable. And then D2C, you have again $20 to $100 in terms of each order value, very much similar to Shopify. And then you have B2B2C, you have Zomato, DoorDash. Once they establish, they control the market, they thrive in that market. And then you have your startup, again B2E. If you build a startup in B2E, your failure rate is much lower. You're looking at $50,000 or $25 million per year. And all you need is like 10 to 50 enterprise logins or 100 B2B small businesses to make actually a good profit out of this business model. Then you have finally B2E, which is like the best model. You need to be like, that is stress free. There's like extremely low risk. I call it the fortress spot. So there is like nothing that can break this model once you enter this model. So let's move on to the next part. What you need to build for being a B2B or a B2C, any model. You need to be solving a pain, not a nice to have. Think stickiness from day one. If you have a really good sticky product that can scale, that's what investor would want to invest in. Does the user have a problem? Yes. No, kill it. Don't think too much about it. Are they actively looking for the solution? Again, there is like multiple data points that you can use to figure out if someone is actually looking for a solution that you are saying. If yes, great. If it's nice to have, then just kill it. It's not scalable, it's not a startup, it's maybe a business. Will they pay to solve it? Then again, people will sometimes say they would pay, but they will not pay. So you need to test it. You need to go out there, you need to ask people to put the money on the table, and then there is like methods to do this. There is like smoke test that you can use to figure out if someone will actually pay for the product or not. Again, we'll get back to this on a different video. I'll show you how to exactly validate each one of the steps without needing to go and build product completely. So if they are only looking at free tools, it's hard to sell. You need to monetize by doing advertising or some other thing. Again, it's not, a $500 million plus opportunity for VCs. Then let's say you build something, you put the product out there. If a user uses it for 30 days and then you take that product away, does it break their workflow? That's how you know if you have built an MVP or not. Again, these 3 steps, will they pay to solve it? Till this, you can completely make sure to get the answers for these 3 questions without building a product, without spending a time. Let's go to what VCs want to see. They want to see these 3 numbers. SOM, serviceable, obtainable market. This is what you can capture in the first 2 to 3 years. For SOM, I will be very honest. A lot of founders think that their SOM number need to be massive in order to get an investment, and if they think that, they are extremely wrong. I'll tell you why. If you can get to your SOM within the 2 to 3 years, and then you go and raise your Series A after capturing your SOM, or you raise your Series B after capturing your SOM, you have data points that shows that, hey, we had a $50 million in terms of SOM. We did well over $50 million, so $70 million we did in terms of our SOM. So then the risk becomes much lower. Basically, you just undervalued your entire company and business model. And then investors look at these numbers and then they say, oh, this is great. You made more than what you thought. So I will invest in you in your Series B. So you'll get a much better, investment terms when you go to the next rounds. So think about this in an extremely niche targeted way. I would say mental health care clinics, EHR for mental health care clinics in Southeast Asia, or mental health, connecting healthcare people of modern, let's say connecting pediatrics nutritionist with moms of newborn. These are the platforms that you should be thinking about. These are what gets you your song. They are like extremely target, your customers, your buyers, your users with. Buyers, users are again different. That's a topic for another day, but you need to calculate your SOM in a way that it's super niche, super target, looking at least capturing a good portion of your market within the next 2 to 3 years without needing to spend exponential amount of money in terms of marketing. Then you have serviceable available market. So how much can I realistically reach? How much is the entire opportunity? So you need to calculate these things. For a VC, your TAM must be at least $100 million plus. And this is like rough calculation of how you might need to lay out your TAM, SAM and so on. Okay, now what stage are you going to raise your money, or how do you get traction? You don't have a product, you don't have ARR, MRR. How do you convince VCs to fund your product? That's a very easy answer. You need to show traction from day one, even without product. If 50 people says I have a problem, that is one data point that you can show. The easiest traction that you can show is signups, wishlist, and LOIs, letter of intent from enterprises or businesses. Pre-orders with deposit, 20% deposit is sufficient, right? And these people will wait for 1 year, 2 years before you launch. That's completely fine with them because the deposit is not that big of a capital either. And then you need to start having pilot customers using your MVP. You don't need to build the MVP in full. You can also service the MVP with people in your office. You need your first paying customer. That's when your MRR starts. So once you have pilot customer, that's your MVP stage. That's when you're raising maybe your seed or even your Series A. And then you are ready for Series A fully when you cross 1 million in ARR. So this is a traction ladder that any companies could follow. And the minute you are projected for 1 million ARR, you are ready for Series A. So I just mentioned about the enterprise sales, how you as a startup can sell to enterprises. Let's discuss about that. So how you can sell to an enterprise. So I think in one of the slides above, I just mentioned how you can sell to an enterprise. When you are going and pitching to businesses and enterprises, you are pitching to CTOs, CIOs and COOs. They are the openers. You talk to them, you understand their problems, and then you are going to find someone inside the organization who is going to connect you with the CTO, CIO and COO. This could be a surgeon, this could be anyone in the hospital, or if you're looking at other businesses like an airline industry or something, there is going to be like pretty much good engineers, doctors, or someone at a managerial level who can give you the connections. Once you validate your technology and once you know that it truly solves someone's pain or problem inside your business, you are going to be pitching to CTO, CIO and COO. All three of them need to give you a green light, and this evaluation takes around 6 to 18 months. So CTO evaluates the tech. Does it integrate? Does it fit well with our architecture? Does it work well with our systems? CIO looks at compliance and data, Chief Information Officer. They look at how the data is being stored, how the data is being transferred. Is there any security vulnerability? Are they safe? And then COO looks at impact. So what is the ROI that you intend to return back to the client? Let's say I'm 10xing the revenue or 2xing the time savings. That's what COO actually looks at. So they are looking at the current workflow, what you bring to the table, how that impacts their business, and the bottom line, basically how much money that they are going to profit out of this. So that's what these three people are going to look at. And once all three of them evaluate, they give the final sign off to CEO or the board members, and then the deal is closed. Here is what you need to think about. If you are selling to SMBs, let's say you sell 100 units in 1 year for SMBs. That's 100x $500 per month. That's 50k MRR. With one enterprise client, you could potentially make $600,000 a year. So that's still 50k MRR. But in order to close one enterprise customer, you're waiting 1 year, more than 1 year at most of the times. Instead, you could easily go to 100 SMB customers and then start like 1 month, 5-10 people signs up. Second month, 20 people signs up. And then you get to your MRR much easier. So you need to think about this. But servicing one enterprise customer is also much easier and better in the long run than like talking to 100 SMB customers. Let's think about the handover problem. Like, what does enterprise actually want? This is all the problems that they have. Banks are built on very old backend systems. One wrong move is complete chaos with banks. Retails are using duct tape solutions, using spreadsheets, and completely a chaos. Hospitals are still using technology from 2010. EHRs are clunky, they are old, they can't migrate, they don't know where the data even is. So switching costs enormous, migration is terrifying, and they all stay and suffer the same problem for the last 15 years. The opportunity for you as a startup is you need to give them painless migrations. You need to give them integration layers. You need to show them gradual transitions, and then you need to show them that you are able to make a dent on the bottom line that they make. So multi-year contracts can be closed this way. You need to give them painless migrations. You need to give them integration layers. You need to show them gradual transitions, and then you need to show them that you are able to make a dent on the bottom line that they make. So multi-year contracts can be closed this way. Reputation compounds every year into the next deals. You need to set the ROI very, very clear and then stick with it. Now, again, going back to the enterprise sales, it's going to multiple SMBs, small business, small, medium businesses, enterprise. So you are getting 500 month 1, 500 plus another 500 month 2. 500 plus few more 500s month 3. So this keeps compounding, but you are also looking to service so many more customers. But you are also going to have a lot of churn rate. So some people might stop paying you, and then you are always replacing lost customers. So you get to like, let's say 50 or 100k MRR in total with a lot of effort, and you need to build your team, you need to service them, and scale things inside your organization. But in an enterprise deal, you get to 600k per year ARR, but you need to do all your homework. So you need to discover them, then you need to show them proof of concepts, you need to walk them through legals and compliance, and then you need to finally sign the deal. The effort for enterprise deal is much larger initially, but once it's signed off, it's much easier, and you don't have to worry about churn, and you'll have a peace of mind in the long run. This is again, traction as a ladder, it's not a switch. You need to show multiple data points on what you're building and why you're building, and whether it's having an impact, whether it's having you're getting paid clients, you are getting your pilots, you are getting your LOIs. You need to keep this always in back of your mind every time you enter a conversation. So let's finally discuss about if you are a business or a startup, when you need to make a switch. So businesses can easily switch into a startup by building a platform on your domain experience. You need to start thinking about how can I automate something that we do every day inside your business, whether it being a website builder tool, whether it's automated sales agency with N8N, doesn't matter. Your business can easily be converted into a startup as long as you know your domain very, very well. And then a startup can turn into an enterprise, but it comes with a very high risk. Going IPO is not a small task. So whether you want to go into an enterprise or not is totally up to you. You can also exit the company where someone else acquires you for a good check. So a good example of acquisition is Instagram was bought by Meta for $1 billion when there was only 13 employees in Instagram, right? And think about each one of those employees having some 0.5% of the stock or 1% of the stock. All of them would have 1% of 1 billion is still, a huge amount. It's like $1 million shares that you are exiting for each one of your employees, plus you're taking whatever shares you have. So that's a huge exit for Instagram founders. And if you want to talk about startups, if you're building your products, if you're thinking about transition, your timeline, investment strategy, your pitch, your portfolio, or you're just trying to figure out if you're a small business, if you're a big business, if you're thinking about scale, you should definitely reach out to me. You can also check out our website, sparkable.dev. I've already scaled 10 plus startups. This is exactly what I do. I look at your technology, I look at what's your financial model, what's your business model, your GTM, go-to-market strategy. And based on this, I can definitely tell you where you are at, and then give you a 6 months to 1 year roadmap that you can follow. For more information about this specific roadmap, founders checklist, you can just click the link below. There is a download button where you can download a PDF file that gives you all the information that you need. You should print it and then have this in your table if you're building a startup.